Hello friends, Dave here from the Short Vol Show Live. Just got back from the backwoods doing some forestry and came in to check the position here. Looks like we have a little bit of a vol crush going on once again today. Let's take a quick look at our old VIX Central. If you're new to the channel here, we talk about the CBOE Volatility Index, otherwise known as the VIX. And I'm going to get right out of the way here, and we could take a look at this here old VIX chart. Now, this chart up here behind me, and I promise I'm getting out of the way right now, is known as the term structure. And what that does tell us is what the relationship between different VIX futures is. And you can see here, once again, even with vol coming in a little bit, we've got the front month future below the spot price. Now, I don't know why the futures guys have things set up this way, but I certainly am grateful to them because look at this number down here in the left corner, Contango, 19.54%. Look at the second month Contango, 8%. Now, for somebody who is long-term short VXX, these numbers are just beautiful, beautiful numbers. I'm thinking I'm going to get an old calendar and just write down every day, write down what Contango was for that day, and we can kind of keep track of it online. But 19% Contango here, and as far as I'm concerned, these guys can just keep these back month futures up. Keep the back month futures up. And when we get a move down in the VIX, let's just we'll just bring that front month future right down and leave the second month future up as high as possible. That's what creates this Contango number here, which is going to lead to like mega decay. Now, when you're in a situation where you leave the second month future up and you take the front month future down, that's going to have an effect of kind of dampening the down move on VXX. So VXX could conceivably be down more today than it is if they'd taken both futures down. But because they are only taking the front future down, and remember, this front future is relating less and less to the overall price of VXX. What am I talking about if you're kind of new to VIX trading? Well, all these products, and by all these products I'm referring to UVXY, TVIX, TVIX, sorry, I've been out in the backwoods too long, TVIX, VXX, UVXY, SVXY. All these products are based on a similar combination of parts of both of these futures here, the December VIX future and the January VIX future. And as the days go by, every day they get rebalanced, whereas the mix becomes more of the January future than the December. So it depends on the cycle, but let's say this month's cycle has 30 days. Every day, 1/30th of this combination gets the December future gets replaced by the January future. So over time, as you know, the expiration cycle is a specific date. There's a specific date of expiration every month. So as we get closer to that date, this December future weighs less into the calculation and the Jan future weighs more. So when they pull just the December future down and not the Jan, that's going to affect things a ton when December is the only future in the calculation or the majority of the weighting. But as the weighting moves, as we're getting kind of late in the expiration cycle here now, and as the Jan future becomes most of the weighting, pulling that DC1 down doesn't move the price down all that much when you leave the Jan one up. That's why when you look at the chart today, you see VXX, you see the VIX down 59, you see the front month future down 27 cents, and the second month future down 22 cents. Let's see if I can highlight that for you. Essentially, VXX isn't down that much because the most important future is that Jan future, which isn't down as much as the second month. And when we get that situation, essentially in my mind, I see it as a trade-off. We're sacrificing not having VXX down as much today for an increase in that contango percent. Now, the contango percent is going to tend to decay this thing long term. So we're sacrificing a little bit of money today, or a little bit of less of a down move today in VXX for overall faster decay for this stuff. Now, 20% contango, which we're showing today, is almost unheard of here. And it could mean a couple things. One thing that comes to mind right away is that there's the potential for a pop up in the VIX back to these levels of 15 or 16. There's a high potential of that, and thus they bring the DEES future, but they're leaving that second month future up there. Remember, with the VIX, it's unlike trading futures. It's unlike the relationship of the term structure in the SPX or other things that are traded. And I know I harp on this a lot, but this is due to the fact that there is no direct arbitrage. Now, that's fancy mumbo jumbo for meaning that they can do whatever they want with these futures behind me as long as the future matches the spot price on expiration. So we're getting closer to expiration here. We're about a week away. Are we a week away? Let me take a look. Sometimes I get confused here. If I go to UVXY, we can see the ProShares website. And that's going to give us the exact date of expiration. You can also just look at the expiration date for the front month future. Any sort of way you can find that. But I like to go to the ProShares website and check out daily holdings. And we are going to see here the December future expires on the 18th. So we're getting very close. We show here 39,000 of the Jan futures to 7,000 of the December one. So we're getting pretty close to expiration here. And thus, this December future is becoming less and less important to the whole equation. So as they pull this December future lower and leave the Jan one higher, the disparity creates this contango percent. Now, actually, as I spoke what I just said in the last couple sentences to you, I was noticing when we do look at the futures today, the December one's down 19 cents, or just popped to 22 cents, whereas the December future's down 26 cents, whereas the Jan future's down only 18 cents now. So it's only like 5 cents difference between how much they've moved down, but 5 cents disparity every day over a long period of time creates a bigger and bigger disparity and more contango. So as this stuff shifts down and as the VIX moves lower, a difference of 20 cents becomes a higher percentage when the prices go from, like, if you've got futures that are like 22 and 20, a difference of 2 points is not as significant as when you have futures of, say, 8 and 10. So, or 10 and 8 to move the analogy forward. In this case, what's happening is as the VIX moves down and the structure stays intact, it becomes more and more of a contango, just having a certain amount of cents difference between the two futures. So this is very exciting for long term. When you get contango up, it's very exciting to have 10%, but when you start to move up to 11, 12, 13, 20%, this is really, really exciting. Because remember, in your mind, when you see this contango number, you can actually multiply that by 12, because most of us are used to percentage terms in a yearly percentage or a per annum percentage. So when we see this percentage here, this is a monthly percentage. It's probably one of the only things you'll see in your life that's giving a monthly percentage. And thus, you can multiply this in your mind times 12, and you get this massive decay. And yeah, when contango is like 3-5%, it's pretty unnoticeable day to day. week to week, it's pretty unnoticeable. But when you've got Contango up here 18-20%, you're going to notice that pretty quickly. And if we stay at this kind of Contango, you're going to see these things. Really, it's not noticeable like one day, 1 minute to the other, but you're going to notice this like on a monthly basis, this stuff massively decaying. So what position do we have on right now to try to take advantage of that? Well, I'm trying something new, and I really would like your input on this. Instead of having sort of a conservative position, I have a very aggressive position on now where I've bought out of the money puts in VXX, but I've bought these really, really cheapo dollar cheap puts, but way far out in time. So once again, when you've got really dollar cheap stuff, the percentages that you can be dealing with can get big. So what did I buy? Well, I bought a little smattering of all kinds of different of these dollar cheap puts. So let me list them quickly for you here. I'll get out of the way for a sec. You can see my position and close up on it if you want down there. But I bought some 17 July 2028 puts, 17 July 2029 puts, 17 July 2020 10 puts. So that's the closest. I mean, I've got these December way out of the money puts that have been worthless for a long time, but essentially the closest thing to expiration of my position is next July. After that, September, next September, which is almost a year away. September 8 puts, September 9 puts. Then I moved out all the way to January, over a year from now. January 21, I have some of the 7 puts and the 8 puts. So what this position deals with and what its challenges are can best be illustrated by looking at our Greeks. So let's go ahead and look at the Greeks for this position. And for that, I'm going to blow the screen up a little bit bigger so that you can see it better, in case you're on like a mobile phone or something. So all right, so here are the Greeks, and when we look at the Greeks quickly, you can see, well, there's definitely a short delta there. That's not surprising. Remember, delta, one of the definitions of delta is the amount of dollars you make for a 1 point move in the underlying. So this shows me if this goes down $1, I make $1,800. Goes up $1, I lose $1,800. So that's a pretty big delta. And then let's go to gamma here. Now gamma is going to tell how your delta moves over time. And due to the fact that I haven't been trading any sort of stock against this or hedging this in any way, in this particular example, gamma is not as significant. But let's move over to the next Greek symbol here, which is theta. Okay, now this position is costing me $55 a day, which is a lot of money over time. So what we're talking about here is time, contango, decay. So the bet here is that this is going to move down faster or fast enough to cover that $55 a day in theta. And A and B, of course, with the delta, this is going to move lower over time. So if this pops up, it's going to show us losing a lot of money. If this pops down, it's going to show us making a lot of money. But we kind of have to put that in the back of our minds for now and just kind of let it ride. That those fluctuations are going to happen up, back and forth in P&L, but we have to look long term here. So the bet we're making is made clear by our Greeks. We're betting that this is going to move down enough over time to cover this daily decay of $56. Now, ultimately, we can look at how much we put into this position, and once we're in the positive, then we're dealing with decay down towards break even, and we want to always keep in mind where our break even is here. And the beauty of this position is that it's a long-term position, so we can make adjustments over time, and that's great because it means that if this position starts to lose money, we're not just going to lose all our money at one moment. It will lose money as this is a slow process here. So Yes, it can lose money quickly if we get a spike, but the spike is not going to last a whole year, and it will come back. So this position is, if it works out, it will make money slowly, and it's all a calculation with how much contango do we have going on to pull us lower, versus how much our position is slowly decaying. Because when you're long, just long puts without it being a spread or something, it is going to decay. There's going to be a positive theta, certainly. So what's the plan? Well, the plan is to hang out, and if we actually do move lower from here, to maybe hedge some of these options. Most of these options were bought for less, I'd say for an average price of about 35 cents. So we can find other stuff to sell against that's cheap, that's a good deal. And the overall plan partially would be to sell stuff against, as the stuff moves lower, sell lower strikes and other things against this stuff so that we can slowly take our money off the table that we invested in this and still have a position that has a potential to make a lot of money with our original money completely off the table. That would be a really exciting goal to work on here. But there you have it. I'm curious for all you volatility traders out there who are experienced to weigh in on what you think about that position. Whoa, I just got huge. To weigh in on what you think about that position. I wonder why my head just got so big. Let's see if I can make it smaller there. And tell me what you think. It's very exciting out here today in VIX land because we really very rarely see contango pop over 20%. And I suspect if we pull up the chart now, yeah, it has gone back down to a 16, 17%, but even a brief period of 20% is pretty amazing. So we will continue to monitor this situation closely here. But yeah, just really excited about the contango levels we have here. Now, once again, for my positions to work, I need to stay. The break even I have to figure out, but I would suspect the break even for my position is somewhere around contango, staying around like maybe 7%. So up here around 16, 17, 20% is just, that's really helping me to stay ahead of that theta big time. And if we can stay up at this area, which is very, very unlikely, things will work out great with this position. But days like today are just, it's like a victory lap. I know I'm staying ahead of the game when we see contango levels like this, but these are really extraordinary. Let's go back to a historical viewpoint on contango on this chart, and then I'm going to end this because I don't want to make these too long. So if we look quickly at this chart behind me, we can see historical contango levels. And usually I make this chart a lot smaller and just look at the current year. But let's look at this since 2010. And you can see everything below the red is backwardation. Everything above the red is contango. And we are looking at a break-even point of, I said, like about 8%. So 8% would be about here. And you can see we are way above 8% now, and we've actually topped 20% here. It doesn't show it here, but we topped 20% briefly today, and we're hanging out in that upper rare area above 15% here in contango. And you can see from this chart very clearly that these things don't last very long. They never last very long up in this area. But for the brief moment here, while it is up there and we do have the short position on, it's helping us immensely today. So it's a smiley, happy day for us short vol traders with this beautiful contango in place. Thanks for joining me, and I will see you in the next one. Please don't be a stranger. Say hi, drop your comments, info. Why is contango so high right now? Ron Lee says, well, it's a bunch of things together that have been building over time. As we've rallied over a long period of time, contango has slowly built, And so it's kind of like we've put money in the bank with this contango, A. B, we're very close to expiration, so the front month future has to go down towards spot. It has to, because we're very close to expiration. But the second month future, they're going to leave up, and that's due to uncertainty. So we've got a VIX that's moved down, combined with a lot of people that are uncertain with the market and kind of are saying to themselves, I don't think the VIX is going to stay very low for long. And when you've got the majority of people thinking the VIX, quote unquote, shouldn't be down here and is probably going to pop very soon, but the VIX is down here, you get this this disparity, which brings that big contango number right there. So I think that's what it is. I think it's a combination of a lot of people and professionals nervous about the market, combined with the fact that, well, the reality is right now that the indices are not moving around very much, and and the VIX is lower and has been moving lower, but a lot of people feeling like this probably isn't going to last very long, and thus they're keeping the futures up higher. People don't want to sell futures way down into the hole here where they see the VIX being. And when you've got a disparity between what the market is doing right now and what people think the market will be doing very soon in the future, you get these big contango numbers like this. Now, my position would love it if those people who think things are going to pop pretty soon are wrong, and actually the market does stay calm. But from experience, I know that usually when we see these big contango numbers, they're followed by some sort of pop in the VIX. So I'm expecting a pop in the VIX here, but if it doesn't happen, my position will do great. That's kind of the shorthand summary here. Thanks, Ron Lee, for commenting and watching, and thanks for everybody else for joining me today. And I wish you the best in your trading. And I'm going back out to the woodshed, and I will see you shortly. Bye-bye now.